Club 1, Jesse Webb, Traders Pro. Market conditions remaining bearish in a bull market. Let's look at direction alerts here. We've got this overall setting. What this means for traders is you should consider, and investors consider, trading with a bearish bias, raising stop levels on winners and selling losers. Aggressive traders can be looking for put options or shorting stocks. Pardon me, the rank of the market 14.7. So what that 14.7 represents is where we're at on this indicator right here. So we know that we've had this big run up. We're kind of flattening out and pausing right here. The question is, how much of a pause do we need to retrace a little bit before we can continue higher? And so at these levels, we'll take a look, though. We're going to be looking at reversal risk location. Now, when I say reversal risk, it's not, it really is just focused on the extremes. So when we talk about momentum, and we've had a really aggressive move this direction to the downside on that indicator, and it shows up on price here. Once you get into these extreme levels where we've had a drop from here, something like this, where we get over to this range to where the sustainability of that trend without a move back up of some degree is just unsustainable. It certainly can continue if we get kind of fear and capitulation in the market. But once we reach that level, then sellers start to dry up and we start to see new demand zones. So when you see this area and it's bearish, we're moving down, but it's actually green because we have bullish reversal risk where we've dropped down bearishly. Forgive me. We've dropped down to the downside and looking for support. We've gone too far, too fast, and may need a bounce. Whether that bounce turns out to be just a little one up and then back down again, never quite know on that. But we're at that location now, both on momentum and breadth, and then sentiment really didn't move, which is also a bullish sign. So these three setups right here are in a situation where we could see a rally or at least a relief bounce of some type. Same with the buy-sell ratio. We've now got this extension here where we're moving wide, and once we get to these upper ranges, it just doesn't sustain there. It can if we were to get some additional bad news or some catalyst that really spooks the market and really fears it to the downside. But we're at that level historically where we start to see some bouncing happening, and same with the sentiment location. We talked about the bond yield curve yesterday. I won't get into that, but we're also seeing, we've been talking about bonds and talking about where those bonds are at. When you click on the sentiment tab and you come over here to bonds, T-bonds, you can see we're just, it's off the charts low. Okay, it's the reading. It's gone to zero at this point. So if we were to look back over the last few years, particularly this year, really, that's probably the most important one. But over this 3-year time frame, you can see that anytime we've been this low, there's been a handful of times where we've been this low, this last low, and now currently here. So bonds are definitely at a location where we could get a bounce right at these areas. These are just unsustainable locations. And so if we were to look at, we'll go back in and look at TLT here in just a minute, but this can also give you an insight of the edges. Again, when I say edges, I'm talking about up here and I'm talking about down here. These middle ranges tend to be that trending zone where it's bounced off of one direction or the other and is starting to move back to that direction. So we want to focus on these extremes, these edges, when we're looking for maybe early entry or at some point to say when's the pain going to end, and watch for some of those. On the notes, let's see if we've got anything interesting here as well. We can go back to this 1-year time frame. Not super extreme there as well. Light sweet crude. So we know oil's had a big run up. So some of these other indicators you can use. S&P 500 is the one that we've been looking at mostly. Volatility index also moving, kind of stuck right in the middle, not at an extreme location there. If we look at, let's actually jump to SPY and we'll take a look at that chart. We talked yesterday about this 50% retracement location. So this actually is an up day. If we change this over to just regular candlesticks, you can see we're starting to get, this was an up day. It gapped lower, then it traded higher. But that 50% retracement zone, we've broke this 382, we're at a 50%, and that could also create a bounce. But we're in that range where we could certainly be seeing some support on the 1 year chart. Let me actually just remove that volume off there so we can see it just a little bit more clearly. If we can't rally back up above that 433, that next stop of 416 is probably where we're going to end up to find some longer term support. We also, we're looking at the overall market conditions. One of the things you can look at is go to sectors and then go to this sectors ETF and then just look to see that, you can see the entire, it's just a further breakdown of each of the sectors inside the market. All of them are still in downtrends, and the others that aren't are trying to find some support right here. Energy, utilities, financials are currently the leading sectors inside of that group. So market conditions still not fantastic, but we are towards an area where we could see a bounce. Some good looking stocks in the muscle stock group today. CAMT, which has got a nice breakout. We change back to this perspective here. Early in the buy zone, and everything is green. A nice retracement inside the momentum location and a massive confirmation bar. And those confirmation bars, I like to use a stop loss either at the low of the bar or at the low of the prior hold signal. So in this case, it's about 7%. You could drop that down. It's probably closer to 10%. So when we have a big confirmation bar, that just allows us to create our risk profile to say, I'm going to set a stop loss here or here. And if it reversed all the way back down, then obviously I'd say I'm out of that one. Or if it reverses all the way, again, wherever you set your stop loss, that's your line in the sand to say, for whatever reason, the uptrend pattern didn't continue. I have no control over that, but what I do have control over is the money in my account and where I place my stop loss and the risk that I'm allocating towards that idea. So always set that up in advance, making sure that it's never more than is going to create, never more than a pain point. Stop loss shouldn't be painful, meaning, ouch, I can't pay my mortgage now, or ouch, that really hurt my kids not going to college. It should just simply be, ouch, that really stunk, but I'm not going to, financially, it's not a big deal. Okay, so the idea of risk management, making sure you're not just swinging for the fences on each of these. Probably speaking to the choir here, but it's very, very important. It's one of the most, if not the most critical part of being able to stay consistent is making sure that you have your risk set up in advance. OII, oil fields, nice confirmation move here. Also bouncing off of the momentum zone location here. Some support, continuing that overall upside. Let's take a look at just a couple of others here and see, because there were some nice confirmation bars and they're all sitting right, nicely inside of the buy zone, and they have good looking patterns. They're not real sloppy. They're smooth trends. Those are the kinds that we like to look at, and there's quite a few. So we're seeing some bullish activity in the market right here, even though it's bearish. Again, the bearishness more than likely is the current trend, but watching for some of these bounces on as the market gets back to that extreme location here. Again, it could drop all the way down. Remember, bonds, this is the one that we're really watching. Really want to see a rally in bonds. That means rates are going to come back down. In fact, this ETF scan, we found there's an interesting ETF in here. It's this one, PFIX, which I've mentioned this one before. This one actually is an ETF of rates, roughly. But it is tracking interest rates. So you can see as rates are going higher, this ETF is moving higher as well. And it just like bonds would be to the downside, rates are extreme to the upside. So it's also due for a little bit of a pullback. So, and I think the market would welcome that, to have bonds pull back and interest rates or have bonds rally and interest rates pull back. That I think equities would welcome that scenario. That'll do it for today's update. Everyone have a fantastic day today.